by the time you hear it, even if it's live, it's already well in the market.
Hey, welcome to Hedge Heads, where we discuss the commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. Well, no one knows where the market's going. We're not afraid to share some ideas. I'm Ryan Tunkseth. He's John Prishman. Well, John, a beautiful day but it won't stop raining around here. Been able to get out and fish or do anything? I know you haven't done any yard work.
I have to do a whole bunch, but I have not. And it's a tale of two worlds. A lot of farmers around here got planted, and then some guys kind of waited for the soil to warm up. And I think that they're not very happy. But yeah, it's been hard to do anything. We have to be in one of the wetter regions, in this little zone, because I'm not hearing the same thing on the phone. A lot of guys are dodging rain and getting in, and they're moving around. But here it's just kind of been shut down with more it just seems to rain somehow every day or every night, at least a little bit, and sometimes a lot. So we went from no moisture for 3 years to way too much, which, welcome to here. Western Iowa, I think, they're in a worse situation from what I understand. But hey, it's spring and it did rain.
Right. I always like to judge total crop conditions on my backyard. So
yeah. Look out your window and mark it. That's great advice, Ryan.
Yeah, thanks. That's I highly recommend that. Speaking of markets, let's roll down these quotes here today. Soybeans, July soybeans down 18. July and December corn both down 2.5 cents. Wheat up 5. Crude oil up $2. The Dow down. ES down. S&P 500 down. We don't do quotes, right? That's the first time we've ever given actual quotes, and we're not live. This is a podcast. Why do we not care about the actual numbers?
Well, first of all, you hear it so often, and you can tune in to RFD TV at night if you want to see them again. It doesn't do people a lot of good. In my opinion, if you're into the markets, you're probably aware where they are. I was on the radio for 3 or 4 years here locally, a pretty big radio station, and they wanted me to do that. I would always spin away from that and just start talking why it may be moving or what's going on. I definitely did the quotes, but it's just old information. Information travels so fast. There's a lot of radio programs that you can tune into and get quotes numerous times a day. It just doesn't seem necessary to me. Although it's a big part of trading, obviously. I just assume that people are probably looking at the market, so why go over it again? And then you're going to have old data. It's by the time you hear it, even if it's live, it's already well in the market. It's just very few times besides droughts where you hear how dry it is repeatedly that you can actually join that market and make money. Usually after you hear the story on the radio or anywhere else, it's well in the market. So it's not that I don't think they're important. It's just, in my opinion, it's not as helpful as maybe the meat and potatoes. But we definitely, the goal is, we recap markets and go over stuff. But I just think the live quotes, there's not a lot of reason for them. They just change. It changes so fast that that's not a big concentration of us. I think just like I say, why the market's moving, where they're moving, what's likely to happen seasonally. Just stuff like that I think is much more important than giving live quotes. And then, it's a big day in cattle and just it's already the market. It's cattle had a good day. Try to figure out why and where we're headed, I think is more important than where so we just don't concentrate a ton on that. We definitely will go over it, but that's why.
Well, and yeah, to your point, this is a recorded podcast. Who knows when people are going to look at it? And the actual price of soybeans today, or the price of live cattle right now while we're recording, doesn't mean a thing.
Yeah, when we both get more time, which will be soon, we do plan on doing the interesting market update during the markets that we're looking at. Again, these won't be recommendations, but markets that are jumping out at us as it is trading. So that's something that we are going to add most likely almost every day, and it's probably going to be 5 minutes. So if that's your thing, we'll try to be consistent with times and we will add that, to it'll be more of an interesting market, or more of a markets that are diverging, that aren't usually unusual moves, stuff like that get our attention, and I think that's useful. So we do plan on adding that.
I agree. I think there are always interesting markets. It's finding them. There's always a market that doesn't fit whatever is going on right now that you want to look at and say, why does that look like that? Now, whether it's a buy or a sell, or we're not going to say that, but we can say
yeah, we really can't. And cocoa was that market. Now that's disappeared. There'll be a new hot market here pretty soon. One direction or the other. There'll be something. The Dow's starting to look like that market where you've seen these patterns. Go look at the chart, and you got kind of a double top, and you've seen these patterns, but this one's looked a little different on the way down. There hasn't been this fight back and forth on the way down so far. So that's what we're talking about, divergence. This looks different than the other sell-offs so far. It's very orderly looking selling, and it's happening all day, which happened again today. Does that tell you that it's going down? No, but it is something different. So divergence is very important in markets when you start seeing something that you don't normally see. And that's kind of why I'm more of a tape reader. I like to see the order flow. Is money flowing in? Is money flowing out? And it definitely looks like it's creeping out of the stock market for some reason today in a very controlled manner with no buying. And that's the part that's different. There's been big surges up, even if it's been a down day where they're bottom picking, or, it's just been such a perma bull. This one just has this orderly look to it, and it slowly deteriorates through the day. Very different look than we saw. Not enough to trade on, but at least something that I haven't seen in that for a very long time.
No, and I would say likewise, when you look at across the markets, we see some things today that are, jump out to me that make sense to look at. Like the dollar was down along with the Dow, oil was up, and grains were down aside from wheat. Like there's some things you can look at and say it's not always the case.
A lot of divergences today. It was the corn wheat one was a big one. That spread widened out even more, where corn did not want to follow after everything gapping up overnight. The corn and beans failing against wheat, still trying to be strong. Definitely got on my radar screen today. The beans heavy bear spreading. Also, again, a pattern that we haven't seen for a while. Where you saw very heavy bear spreading in almost 10 cents up front, July, November, which would be old crop, new crop. Very heavy bear spreading, and we haven't seen that look in a while. So that's when we're talking about things that stand out to us. That's the kind of stuff that we would be talking about. Now, you don't trade on that just because it looked different today, but you want to start seeing these patterns. If you're starting to get more of a consistent bear spread in beans, even on the way up and on the way down, then all of a sudden, that's something that I might trade. One day a pattern does not make, but if you see it enough, you just get this. It's almost like a fifth sense of where it might be heading, and that's why I think spreads are so important. I believe spreads tip you off more often than not on where a market's headed. The spreaders tend to be the guys that are in first because there's generally not as much risk. So if you're betting on just say down soybeans, you're going to be like, I'll be bear spreading way before I'll short a bean contract. I had shorted November 24-25 personally and exited today. But that's where if I'm top picking, that's where I am first. And I'm sure that goes for a lot of bear spreaders. And then you're going to have guys with inside information that are going to heavily bear spread that, of course, they're not going to tell you. And we won't know that. We can just see that it's happening. And then you'll see big market turning points. But it's not, again, it's inexactly as anything in trading. You want to try to establish a pattern. So if it's consistently bear spread this week, in my opinion, the funds are probably done dumping money into beans for now. But again, you just try to read the tea leaves. That's just another piece of the puzzle. I think spreads are super important. I don't know how anybody markets without them, without at least looking at them. You don't have to trade them. And understanding where they're at. If you look at July, November beans for the last few years, I think plus 90 to plus $1.60 of this time of year. We're inverted maybe 10 cents now, 12 cents, which is the lowest it's been in many, many years. So there's not much difference between old crop, new crop. It is inverted slightly, but a lot less than you would have thought. You would think this time of year. especially with what we planted last year, how the year went weather-wise. To have too many beans around this time of year is not a great sign, and the spreads woke up for a little bit, and now we're trending the other way. But I tell you what, with beans, it can be a volatile time of year in spreads just because the last of the old crop, if there's not a lot out there, you can get these guys to bid the front up very, very quickly. But it's not a good sign the way it's acting right now for sure.
So I've been told if the front is over the back, it's always bullish. And if the front's under the back, that's always bearish. And so
yeah, they say a bull market's led by the front. I mean, that's an old saying that it's, that's a healthy market. That's what you want to see. You're not seeing that in corn. You are seeing inversions in beans. Earlier, you had seen inversions of wheat, which failed spectacularly. They were heavily inverted, actually, early winter, and kind of surprising. And now they've all fallen to carry. Some of the deferred stuff is still inverted. Again, this is where I operate. I love deferred spreads. It falls in the front, and oftentimes you can get involved in the back end too. The back end falls a lot later. So it's almost the front tells you what it's going to do. And then I like where nobody's at, where it's nice and thin. You can't, do a lot of volume back there, but usually there's some opportunities. So you're seeing, like you look at the deferred corn, like July 25, D's 25, that's still inverted. It was 18 cents on Friday. I think it was like 16 something today. Last year that went to plus 60 on that hot and dry in June. And then it ultimately, I think, went to minus 45. So these things are, if I'm not mistaken, that was the spread moved more than corn to the downside. So July was 60 cents above December. Later on, it was 45 cents under, if I'm not mistaken. So that's a $1.05 move. And I don't believe corn moved $1.05 down. Some contracts probably did in the summer, but it was quite a switch. So it's very common this time of year to have inversions. It's especially deferred. And then if the weather's good, for all those inversions to go away. Now, what's been different the last few years is we've had inversions for a long time. This is the first year where they've kind of all disappeared. Like May was over July corn. Just even same crop year, it's been inverted. So what this tells me is supply is building. There's a lot of denial about it, but the spreads don't lie. Like supply is building. They're building commercial carry. And the next 3-4 weeks of weather are going to be super important, whether we invert more in the back end or we start falling to carry. Very important time of year.
Yeah. And I would say, yes, inverted is generally bullish, but you got to look at where the inverted was and where it's going to, right? Like it's not bullish until it turns negative, right? Until it turns to carry, right?
Yeah,
it's how they're moved.
You want to see like in those big markets, like 2019, like near full carry, and then they, the demand. It's the demand that cleans out the commercial pipeline. That's where you get your big inversions, where they have to bid it up to get it out of your hands. If you're a producer, they have to dangle that carrot and say, hey, if you store it, you're going to get 30 cents less than if you just sell it to me right now. That's why it gets inverted. They need grain in the pipeline. So when you see these heavy commercial carries, they're likely to sell the carry and just sit on that grain, and it kind of feeds on itself. You get paid more for just sitting on it than you would for selling it. So that happens really badly in wheat, and that's what it's known for. Corn and beans, it definitely happens commercially. Once those commercial channels fill up, it gets to be really hard to invert the markets unless demand takes it off. So that's why I think that's your first clue as things are changing. So we went from inversions to carry, and I see that as a big change this year. A lot of guys are still in denial about, saying it's not out there, and we're going to go way higher. Those voices have kind of died down a little bit. So we've gone from inversions to back to carry. And of course, now if you're looking for a bull market, you're looking for them to take carry out of the market. If it's not actually out there, that's what'll happen. So that's why you can't lean on spreads 100% because the funds will skew them. When they put money in the market, it might move spreads when they shouldn't move, just because they usually buy the most liquid contract up front. But just overall, we're at carries again. Going into summer, that's not exactly where you want to be, but the next 4 weeks are going to be important.
Now, we've talked a lot about grain today, and that is it's the time of year where grain is the hotter topic. But what about cattle, specifically cattle spreads? I know you trade a lot of cattle spreads. What are you seeing there, and is there anything different when you're looking at a cattle spread or a hog spread versus grains?
Yeah, you want to, cattle has some great spreads, and it's somewhat predictable to some degree, just watching fundamentals. So I do really like them. The way this is structured is because of the cattle on feed report, not this last Friday, but the previous cattle on feed report had like December on back. The placements were low up front. So that means the December live cattle, by the time they're finished, there won't be a lot of cattle according to the USDA. So they've been buying the back end where the front end's been kind of a laggard. The back end's been the hot one. That's not a good structure to a market when they say it's going to get bullish, but it's actually not there yet. That's where cattle's at. Like, we're not going to have the cattle in the back end. And then they put premium in there, and usually, like last year, it did not live up to that. What did they have? April live cattle up to $199.75 for a high, and we didn't get anywhere near that price in actually April. So the cattle's been odd. There hasn't been a lot of opportunity that I've seen just because they've been buying the back end, unless you want a bear spread, which would have been, short the front and long the back end. That did work right after the cattle on feed report, but right now everything's where it should be. October is what, $3 or $4 under December. December is under February. February is under April. Everything's structured exactly like you would think it would be this time of year. Seasonally, it would be bear spreads, but of course, with the fundamentals we have, not a lot of guys are interested in that. So not a lot of opportunity. What does the cattle market tell us? They got it structured in a way where they have a lot of good news built in. We'll see if it lives up to the hype. It did not live up to the hype last year. And that when it's structured like this, generally it's good for the producer that hedges because it gives you a price that's not maybe going to be available when it gets to the front. And that's what happened last year. So if you were shorting 199, you were very happy once the front rolled around because it was 170s, 160s. So it offers the hedger a wonderful opportunity when they structure it like this.
And those are markets that we specifically look for. Or going back to our beginning topic too, when you see these structures, like now is a good time to look at X, Y, or Z. I think
it's critically important to look at the right contract in the right month. Obviously, for cattle, when your cattle are finished, you want to be doing the correct months. But you want in grains and cattle, if there's some leeway, you want to look at what's, for instance, let's say October cattle was $850 under December. Historically, that's what as wide as that carry's ever got. So your hedges are smarter in December than they would be in October, unless you absolutely don't have a choice, but your cattle are for sure going to be finished in October. Why those spreads tend to narrow is because if you can get $850 more on the board, at least through hedging, why wouldn't you just hold those cattle back, feed them a little more, and get that money? At least if you're in futures. So they tend to narrow when they get that wide. And sometimes they stay that wide if it happens right, like a 2008 financial meltdown. If it happens right when the contract's going off the board and there's some sort of meltdown, they can stay wide. But generally, it'll even itself out by saying, hey, why would I sell these cattle for this? So knowing what month to do when and to what to your advantage, especially when you're in options, is huge when you're looking at spreads in cattle and especially grains. I've seen more people choose the wrong months for hedging. And again, of course, it's partly in my opinion. But if you're at full carry, max 120-year low carries, you're going to want to look at a different month than maybe going in the front because the only thing that can happen is the front can gain on the back end and your hedge is going to be better in the next month. But that's a whole nother podcast conversation. But it is vitally important, like you said, to be choosing the right months with your hedging. Feeders are very, that's a market that is, you almost need a specialty to know what month to hedge there, like a specialty degree in feeder cattle hedging, because that one is where the cattle are light and you can make a lot of different decisions on when to market those. So that's a really important one to know what month belongs where at what time or what's mismatched against what month. And the spreads have been absolutely wild for years in the feeder cattle, where you're seeing $12, $13, $14 differences between just a couple months.
That makes sense. We talked about markets that were maybe doing things we don't expect or higher, lower than you want to see. Let's talk about the most boring market right now for a second. Crude oil hasn't moved been sitting there. We have a market that's kind of at equilibrium. We've talked about that for 2 months on this podcast. How does that happen? Are like when you see a market sitting in a $2 range for months and months, what do you see?
Well, that's funny.
$10 range.
That's the funny thing is that's the market's goal to get to that price where it's not moving around a lot. That is the goal, to find that equilibrium price. But the ironic thing is that's no fun for the traders. So they tend to, it just kind of falls by the wayside until it wakes up again. That definitely happened to interest rates for 10 years. Where those were very active markets, and all of a sudden it's just, everybody kind of left that or quit watching it because the interest rates didn't move for so long, or if they did very little. So oil has been that market, hasn't been exciting. There's been a lot of news. It just hasn't wanted to move it. So it's found the price that it's very comfortable at, where producers are making money, consumers aren't getting hit too much with the demand's not dropping off yet. And that's really, ironically, the goal of the market, to find that quiet price. Then it's correctly priced and the market's doing its job. But that's not what the traders like. So that's why we haven't been talking about oil. Without a doubt, that'll wake up. It always does. But it seemed to find a price that was pretty comfortable at. It is election year. So that'll probably play into, you already saw that they're going to release some gas, unleaded reserves. These are moves you wouldn't normally see. But no, been very stable. I mean, I'm not angry when I fill up the pumps, but I wouldn't say it's cheap either. But it's a nice stable price.
Speaking of being angry, I got one little story I'll share with you. I was up in Fargo for a funeral, and I was filling up with gas prior to going there, and I was trying to make sure that I was going to the right church while I was pumping gas. And so I fill my tank, and I looked down and realized I was so busy looking for the address on my phone that I filled up with the 91 premium, no ethanol, like the top line. So I was real happy. I spent $1.25 extra per gallon to put some, the premium. Is that a word, premium? But
I think you made that up, but yeah. I like it.
Perfect. My truck didn't run any different. I was hopeful, I was going to be able to.
That's where you're wrong. It's running on high octane.
Okay.
It's running very good.
I mean, I feel bad I didn't get any ethanol. These poor corn producers,
just like a
help
teen,
them out.
You just like a teen. You were looking at your screen and you messed up. I mean, that's the moral of the story there. I don't think you just pump your gas and then look at it. No, it's not going to hurt you, but you paid more. But it's better than my friend Mike from a long time ago, Disney on Ice. I think we were in Sweden and we were going skiing. They rented a car and we rented a car. Mike is from England, very smart guy, electrician. And he didn't make it to the hill, and we made it to the hill. And I don't remember where it was. Even if I did, I couldn't pronounce it. I don't know if you've ever seen the chef from Sweden on the Muppets, but it sounds just like that. Anyway, he didn't make it, and I asked him what happened later, and he filled up, and he put diesel in there instead of regular, but the guy came out and he kept saying, gas oil, and so Mike, every time I saw Mike after that, I said gas oil, and you don't want to, at least he didn't do that.
I'm very glad I didn't put the diesel in.
Gas oil.
That would have been bad. Gas oil. Perfect. What else do you have for us today?
Nothing. It's, and I've said this a few times, when you're working and you have absolutely no time to look at this in the grains, and this is a busy time of year, no doubt, is going to be the time when you need to look at it. So the next 4 weeks is going to tell the tale. Even this afternoon, we have 2 o'clock. We're just shy of that by the time you hear this. The crop conditions are going to come out. I think they expect 70% planted for beans, 85% for corn. Those seem like high numbers with the weather we have. We'll see what they say. So it's the interesting time of year where rain is bullish, and it has been. And then all of a sudden, one day like magic, it turns bearish. And we're right in that weird zone right now. Are we far enough along planted not to worry about that anymore? Or is that going to be worried for another week? And then what's the weather behind it? But with all this rain, I think guys are getting a little nervous that day is coming soon where that does turn bearish. So we'll see the numbers this afternoon. But these are some of the most important weeks of the year for marketing. It can come earlier in this time frame than later. Last year, I think, what was it, June 21st? We were in Grand Rapids at the time.
Yeah.
When the top came in, I remember perfect, huge reversal after going up substantially, and that was all she wrote for that year. That was later in June last year. The year before, I believe it was as well. And the previous 2 years were in mid-May. So this is a super crucial window for highs to either come or go, if that makes sense. We have a different weather pattern this year as it is every year. So it's hard to know where we're at in that window. I don't know. I mean, I'm not confident tops are coming in. We might have a long ways to go for that. And then you throw the wheat market in there. Who knows?
Yeah, it's certainly been an interesting spring compared to the last couple of years where it was a little more, at least felt more predictable than this year. And
yeah, you throw wheat leading the grain complex at this time of year in there and, all bets are off. You don't see that very often.
I don't trust wheat on anything. So
no, and that is the problem with wheat. Even when it's real, it's hard to recognize if it's real because it can be, and when it is, it's explosive. 9 times out of 10, though, it's a false start. What happens is, okay, so Russia's production's hurt. All this demand is going to come to the U.S. is what they think in their mind, and then that just hasn't happened since 2008, where we saw like low supplies in the world, and the demand actually came to us to where we're almost out of wheat as well. Exceedingly rare, more hype than substance, kind of like Lucy kicking the football on Charlie Brown. It seems like that again, but you never know with wheat. I am worried that this could actually lead the entire grain complex on another run higher, but it could easily be done too. You just never know with wheat.
You never know with the markets either, which is why we don't make recommendations on something you might listen to 2 months later.
Yeah, yep. You just got to take it day by day. And, you're looking for signs. Today it didn't look good in the grains at all. The big gap up on a Sunday night and a complete reversal with oil being very strong, the dollar weaker, and wheat trying to be strong. Not a great look for the grains today, but we've seen things change on a daily basis. Again, you can't wait. Unfortunately, you can't wait too much into one day's action. So I'll be interested to see if, that's a tone we set for the rest of the week. And then if that's the case, I think the grains are going to struggle. If wheat flares back up, we get some bullish news with this planting progress or crop condition. I think it's the first crop condition out today. Then we could extend the streak, So yeah, in other words, it could go either way. I don't know.
We're here to not predict the markets and just say, I don't know.
We have ideas, and you can make logical choices for direction, and then use seasonals, and you can tip the odds in your favor. But again, this is a time of year where weather changes often, which you saw this year. It wasn't too long ago that they were hitting the drought talk, and now of course it's been too much moisture, so things change very quick.
Sure. I tend to, especially this time of year, lean on how I feel the market's going to go.
Yeah, that'll help your marketing. I feel it should do this. That's always been a great way to market feelings.
Feelings, yes. I feel pain. No, I
feel like the USDA's numbers aren't right, and I feel like China's going to buy. Yeah, that doesn't usually help. But sometimes your feelings pay off. But I would not market on feelings.
I don't trust my feelings. I do know that. I've lost enough money saying I feel like this should go down tomorrow,
or the market should do this. It has to do this. Yeah, these are all things you want to avoid, and try to go with the flow. Get out when you're wrong. Try to get in before everybody else is getting in. And then get out of a crowded trade. I mean, there's a million sayings and things you should do in trading, but it's an emotional deal and hard to control it.
It always is. Well, thanks, John. You want to mention your number, how we get a hold of you?
Yeah, we've had some feedback, and the feedback we've had, guys want to hear more specific examples of actual hedging setups. So we will do that, but not recommendations. Like we'll take a look at both sides of everything that we do. So we'll do more of that. So we appreciate that feedback, that you want more specific examples. And anything else you have, any questions, or you want to hear different things, 218-731-1578.
Perfect. You can also email hedgeheadspod@gmail.com. Thanks, John.
Bye. Yeah, look out your window and market. That's great advice, Ryan.